Hello everyone, welcome to One Story Channel. In the storms of history, financial crises have struck like relentless tsunamis, sweeping across the globe time and again. From the heights of stock market booms to the depths of economic collapse, millions of ordinary people have been caught in the whirlpools of these crises. These crises have not only reshaped the global economy but have also profoundly affected countless families' lives. Today, we will travel through time and revisit some of the major global financial crises, hoping that these reflections will inspire everyone to be prepared and manage their finances prudently. The 1929 Great Depression, the fall of Wall Street, and the decline of the global economy. The Great Depression refers to the global economic downturn from 1929 to 1933, the most severe economic recession before World War II. It was the longest-lasting, most widespread, and most intense economic depression of the 20th century. During the 1920s, the U.S. economy was in a period of rapid growth known as the Roaring Twenties. Industries like automobiles and home appliances were booming, and the stock market soared. However, behind Wall Street's prosperity, the seeds of crisis were already sown. Overheated stock market, speculative fervor was rampant, with many people borrowing money to invest in the stock market, using leverage to seek high returns. Banks not only lent to businesses but also to individuals investing in stocks, sometimes to those without the means to repay the loans. Weak financial regulation. At the time, the Federal Reserve maintained a relatively loose monetary policy, keeping interest rates low, which inflated the capital markets. However, this prosperity was built on high leverage and bubbles, and regulators failed to intervene in time. Global economic imbalance. After World War I, the U.S. emerged as an economic powerhouse, with rapid export growth. However, Europe's post-war reconstruction was slow, and the imbalance of trade surpluses and deficits made the global economy increasingly fragile. The start of the Great Depression varied from country to country, but most economies began to suffer from 1930, with the crisis lasting until the late 1930s or even the 1940s. The Depression began in the U.S. On October 24, 1929, known as Black Thursday, the stock market saw a massive sell-off. However, the real panic came on Black Tuesday, October 29, when the U.S. stock market crashed, with single-day drops exceeding 20%. The New York Times ran a headline that stunned the nation: "The stock market collapses, wealth vanishes." Billions of dollars evaporated in an instant. In the following years, both the U.S. and global economies plunged into a deep depression. The banking system collapsed as massive loan defaults led to nationwide bank runs. Personal income, tax revenue, profits, and prices all dropped significantly, and international trade plummeted by 50%. U.S. unemployment soared to 25%, and in some countries, it even reached 33%. Countless businesses went bankrupt, and millions lost their jobs and homes. The economic blow particularly devastated major global cities and regions reliant on heavy industry. By mid-1930, interest rates had fallen to new lows, but consumer spending and investment remained weak due to deflationary expectations and a reluctance to borrow. By 1931, the situation worsened as prices for agricultural goods plummeted and unemployment surged in mining and lumber regions. The Depression severely strained European economies, leading to trade protectionism and retaliatory tariffs, which only deepened the global economic collapse. By 1933, the global economy had hit rock bottom. The Great Depression caused serious social issues, with millions dropping out of school and many resorting to suicide. Unemployment was the most critical issue. In the U.S., over 13 million people were out of work, with unemployment rates reaching 25%. Even during Roosevelt's New Deal, unemployment never fell below 15%. Long queues for relief food in U.S. cities stretched for blocks, and in the U.K., up to 7 million people were jobless. Historians point to structural factors behind the 1929 recession, such as banking failures and the stock market crash. Others emphasize monetary causes, such as the Federal Reserve's tight monetary policy and Britain's return to the gold standard. Another theory suggests the Great Depression stemmed from a collapse in international trade, insufficient consumer demand, and governmental inaction. 1997 Asian financial crisis, capital flight and currency devaluation. In the early 1990s, Southeast Asian economies rapidly rose to prominence, earning the moniker Asian Tigers. Foreign capital poured into these countries, fueling real estate and infrastructure investment. However, behind this prosperity lay the hidden risk of over-reliance on external capital. Capital inflows and short-term foreign debt. Many Southeast Asian economies relied heavily on short-term borrowing from foreign investors. These funds were largely directed toward real estate and stock market speculation. International capital inflows inflated asset prices, but when external conditions changed, these countries' vulnerabilities were exposed. Fixed exchange rate regimes. Countries like Thailand, Indonesia, and Malaysia adopted fixed exchange rate regimes pegged to the US dollar, preventing them from adjusting their currency rates in response to capital outflows and trade imbalances. In July 1997, the financial crisis erupted in Asia. On July 2, Thailand announced the abandonment of its fixed exchange rate system, adopting a floating exchange rate, which ignited a financial storm across Southeast Asia. The Philippine peso, Indonesian rupiah, and Malaysian ringgit became targets of international speculators. By October, even the traditionally stable Singapore dollar came under pressure. In October, the Taiwanese dollar depreciated by 3.46% in a single day, while the Hong Kong Hang Seng Index plummeted by over 2,800 points in just 5 days. South Korea faced its own crisis in November, with the Korean won falling to a record low of 1,008 to 1 against the US dollar. By December, Korea sought assistance from the International Monetary Fund, IMF. Indonesia was hit hardest. By February 1998, the Indonesian rupiah had fallen to 10,000 to 1 against the dollar. The impact spread to the Japanese yen, with rates dropping from 115 to 133 yen per dollar in early 1998. The crisis had now expanded beyond regional boundaries, becoming global in nature. By the end of 1998, the crisis abated. During this period, although the Federal Reserve did not intervene directly, it adopted a more accommodative monetary policy, cutting interest rates several times in 1998 to prevent a global recession. The IMF provided hundreds of billions of dollars in emergency loans to the hardest-hit countries, though these reforms often exacerbated short-term unemployment and social instability. The 2008 global financial crisis, the subprime bubble, and the collapse of global banking. The 2008 global financial crisis, also known as the subprime mortgage crisis or credit crisis, was a financial disaster that began emerging on August 9, 2007. The 2008 financial crisis is considered the most severe global financial crisis since the Great Depression of 1929, originating from the collapse of the U.S. housing market bubble. The crisis reached its peak on September 15, 2008, when Lehman Brothers declared bankruptcy. The Wall Street Journal headlined, "Lehman Brothers Collapses, Global Market Panic Spreads." Stock markets in the U.S. and across the globe descended into chaos as investors rushed to sell off stocks, wiping out trillions of dollars in market value within just a few days. In the U.S., the unemployment rate surged above 10%, with numerous companies going bankrupt, while a wave of home foreclosures swept across the country. In CNN reports, many families were seen being evicted from their homes under bank foreclosure orders. European banking systems were also severely affected, with Iceland's 3 largest banks collapsing and the country teetering on the edge of bankruptcy. In the early 2000s, as U.S. interest rates dropped, housing prices soared, and demand for homes gradually increased. Banks began offering subprime loans to borrowers with lower credit scores. The loans were then bundled into bonds and sold to investment banks. The investment banks would then sell these bonds to investors, breaking the loans into smaller pieces to maximize risk diversification. In collaboration with credit rating agencies, these investment banks marketed their products as nearly risk-free to attract more investors. Everything seemed to be going smoothly, but both investment banks and commercial banks assumed that housing prices would continue to rise. Due to relaxed lending standards, everyone was buying homes, pushing house prices higher and higher. However, once home prices reached a certain peak, people found they couldn't afford to buy homes even with loans. At the same time, the Federal Reserve raised interest rates, causing home prices to start falling steadily. Those who had bought homes earlier realized their properties were losing value and decided to default on their loans, leaving investors holding the now worthless mortgage-backed bonds. In April 2007, the bankruptcy of New Century Financial, the second-largest subprime mortgage lender in the U.S., exposed the risks of mortgage-backed securities, MBS. By August 2007, the Federal Reserve responded by injecting liquidity into the financial system to boost market confidence, allowing U.S. stocks to maintain their high levels temporarily. However, by August 2008, the stock prices of the U.S. mortgage giants Fannie Mae and Freddie Mac plummeted, causing massive losses for financial institutions holding their bonds. After the subprime mortgage crisis erupted, investors began losing confidence in mortgage-backed securities, triggering a liquidity crisis that culminated in the 2008 global stock market crash. Despite repeated efforts by central banks around the world to inject massive amounts of money into financial markets, the financial crisis continued to spiral out of control. By September 2008, the crisis had escalated beyond containment, leading to the collapse or government takeover of several large financial institutions, ultimately plunging the global economy into recession. Many financial institutions were unable to survive the crisis, and the severity of the subprime mortgage problem far exceeded what people had anticipated. What began as a subprime mortgage crisis on Wall Street soon evolved into a global financial crisis, with a speed and impact that few had expected. This was the most severe financial crisis to drag the global economy into prolonged recession since World War II. The Federal Reserve's response: faced with the crisis, the Federal Reserve took unprecedented emergency measures. The Fed sharply cut the federal funds rate from 5.25% to nearly 0%. By lowering borrowing costs, the Federal Reserve aimed to restore market confidence and encourage banks to resume lending. Quantitative easing, QE. The Federal Reserve launched large-scale quantitative easing, buying long-term U.S. Treasury bonds and mortgage-backed securities, MBS, injecting liquidity directly into the market. This move significantly increased market liquidity and helped banks escape the liquidity crisis. The U.S. government also introduced a $700 billion emergency bailout plan, TARP, directly injecting funds to rescue struggling banks and financial institutions to prevent systemic collapse. At the same time, the government expanded fiscal stimulus, launching large-scale infrastructure investment plans to create jobs and revive economic growth. The European Central Bank, ECB, took a series of emergency actions, including lowering interest rates and injecting liquidity into the banking system. Meanwhile, EU member states implemented fiscal stimulus policies to protect jobs and maintain social stability. The economic crisis triggered by the 2020 COVID-19 pandemic, global lockdown, and the path to recovery. The coronavirus recession, also known as the Great Lockdown, refers to the global economic recession caused by the COVID-19 pandemic. In early 2020, the pandemic swept across the globe, forcing governments to implement unprecedented economic lockdowns and restrictions. This crisis was not triggered by financial markets but by a public health emergency that quickly transformed into a global economic crisis. Global economic standstill. The lockdown measures led to the shutdown of factories, halted air travel, and disrupted global supply chains. In just a few months, the global economy fell into a deep recession, with the service, tourism, and hospitality sectors being particularly hard hit. Sharp declines in consumption and investment. As uncertainty intensified, companies drastically cut their investment plans, and consumers tightened their spending, leading to a rapid decline in economic activity. Most economies entered recession starting in February 2020. Even before the pandemic, the global economy had already shown signs of slowing down in 2019, with consumer activity stagnating. The lockdowns and other preventive measures taken in 2020 directly plunged the global economy into crisis. The first major sign of economic recession was the 2020 global stock market crash. Major stock market indices fell by 20% to 30% between late February and March. While stock markets began to recover in early April, by the end of 2020, many indices had bounced back and even set new records. By September 2020, every developed economy was in a recession or depression, and with the exception of a few countries like China and Vietnam, all emerging economies were also in recession. Within the first 7 months of the pandemic, every developed economy had fallen into economic recession. In the second quarter of 2020, the Eurozone's GDP shrank by 15% year-on-year, with a quarter-on-quarter decline of 12.1%. France's economy shrank by 19% year-on-year and 13.8% quarter-on-quarter, marking the biggest drop since World War II. Germany's GDP fell by more than 10% both year-on-year and quarter-on-quarter. During the recession, many countries experienced abnormally high and rapidly rising unemployment rates. By October 2020, over 10 million unemployed people in the U.S. relied on government unemployment benefits to support their livelihoods. The 2020 oil price war between Russia and Saudi Arabia caused oil prices to collapse, further hurting the tourism, hotel, and energy industries as consumer activity plummeted. However, after the peak of the pandemic, economies experienced a sharp rebound as global demand surged, particularly in Asia, where energy demand was strong. This, in turn, contributed to the global energy crisis of 2021. By April 2022, most major economies had recovered or exceeded their pre-pandemic GDP levels. However, the World Bank's models indicate that full recovery may not be achieved in some regions until 2025 or later. During the pandemic, the Federal Reserve adopted extremely accommodative monetary policies. Interest rate cuts to zero. The Federal Reserve quickly cut its benchmark interest rate to 0.25%, a historic low, and announced that it would maintain these low rates for the foreseeable future to stimulate economic recovery. Quantitative easing, QE. The Federal Reserve launched another round of large-scale quantitative easing, purchasing U.S. Treasury bonds, corporate bonds, and mortgage-backed securities. It even expanded its asset purchase program to include municipal bonds, providing financial support to local governments and businesses. Governments around the world introduced trillions of dollars in fiscal stimulus measures. The U.S. introduced the CARES Act, which provided direct financial assistance and loans to businesses, families, and local governments to help them cope with the economic challenges brought on by the lockdowns. Similarly, European countries implemented various rescue plans to provide financial support to sectors and individuals most affected by the pandemic. Every financial crisis is a harsh test, but also a valuable lesson. The 1929 Great Depression taught people the importance of cautious investing. During prosperous markets, individuals should avoid over-relying on leverage and should not place all their wealth in a single asset, especially high-risk stocks. During times of economic uncertainty, having sufficient emergency savings is key to weathering the crisis. The 1998 Asian financial crisis reminded us that when investing, we should carefully consider the macroeconomic environment of a country, especially those that are overly reliant on external debt and short-term capital inflows. Additionally, in the face of currency devaluation risks, individuals should diversify their investments and avoid concentrating their assets in a single currency or asset class. The 2008 financial crisis warned us that individuals should be wary of complex financial products and avoid blindly purchasing high-risk investments they do not fully understand. The crisis also reminded us to maintain financial discipline during times of prosperity, avoid excessive borrowing, and ensure we have sufficient emergency savings, adjusting our investment portfolios according to market risks. The 2020 pandemic crisis made people realize the importance of building a healthy emergency fund and enhancing digital skills. During a crisis, maintaining flexible income sources is crucial, and improving digital survival skills will help face future challenges. At the same time, in the context of increasing global uncertainty, individuals should focus on diversifying their investments to spread risks. From the 1929 Great Depression to the 2020 pandemic, history has repeatedly reminded us that no matter how prosperous the market may seem, we must always be prepared for uncertainty. Diversifying investments, borrowing cautiously, maintaining emergency savings, and enhancing personal skills are strategies that will help individuals remain resilient and stable when the next crisis strikes. Please continue to follow our channel as we discuss past and present lessons for a better future.